With inflation remaining consistently above 5%, many of the experts believe that we have a high chance of a recession occurring in our near future. Historically, every spike in inflation has led to a recession shortly after, and this has caused prices to correct and the economy to cool off. On average, we have seen a recession about every 5.9 years. For investors that have patient money or cash sitting on the sidelines, a recession could be an outstanding buying opportunities where you can purchase into companies that were once overvalued, maybe last year in 2020, and you can get them at much lower rates and much better prices. However, for other people that are mainly nearing retirement or living in retirement, it could be very detrimental to your investment portfolio if you have been taking on too much risk and not had a proper diversified portfolio. The other scenario that could be bad for many Americans would be the loss of a job or the potential for local businesses to close down. However, this recession could be very different from what we have seen historically. And I say that because of three reasons. One of the reasons is there are over 11 million current job openings in the United States. So what we saw back in 2008 was people could not find a job during the recession that we saw at that time. That is clearly not the case today. There are plenty of open jobs out there. The second thing is there is a pent-up demand in travel. So more recently, the CEO of Delta came out and said that there was a stretch during the month of March where there were the highest 2 days worth of people flying, buying plane tickets that he'd seen in the history of the company. Another reason is the housing market is still very strong. So we have seen historically high record home sale prices, and that has remained and that has lifted household net worth for 2/3 of Americans that own homes. So with those ideas in mind, it does seem very bizarre that we could enter into a recession. So what are some things that investors could do at this time to potentially prepare for a recession? So first and foremost, you need to keep a long-term perspective in mind. And know it could be very unnerving seeing your investments account drop or seeing what your account was at the beginning of the year compared to what it's at today. However, just know that historically, on average, over a 20 or 30-year time period, stocks continue to outperform and continue to see a higher average than what you saw in the prior years. Also, keep in mind that it is very hard to try and time the market. There is a famous quote by Peter Lynch, who is a famous money manager, and he said there's more money lost in people trying to time the correction than there is with the actual correction occurring. So to paraphrase his quote slightly, what he is saying there is if you try to time the market, if you try to get in or out at a certain time, buy into stocks, sell your stocks, it very seldom works. No one can tell you exactly when the market has bottomed and when the market might start to recover and go back up. One indicator to look at that we saw that occurred last Wednesday was the Federal Reserve. So Chairman Powell announced that he is raising interest rates by 25 basis points. He even took it a step farther and said that they plan to raise interest rates at least 6 times throughout this year. If you watch the stock market, what happened after that, it went on a 5-day positive streak. So what that can begin to tell you is we could have potentially priced in a bottom for the market, at least over the next quarter or two. And also, the market loved to hear that certainty from the Fed. Even though they did say that they're going to raise interest rates 6 times, if you look at historically what happens in an interest rate environment where interest rates are going up, value stocks tend to outperform. They still do have the potential to increase in value, obviously, even in a rising rate environment. The other thing to consider is your time horizon and when you will be using this money. So if this is money that is pegged for the long term, if it's in a retirement account, a Roth IRA, and you're 10, 20, 30 years away from retirement, it's important to not touch those assets because you wouldn't be able to use that money in the near term anyway by selling them, and you could be robbing yourself of those potential gains. Some of the biggest upswings that we see in the stock market tend to occur shortly after a drastic drawdown that occurs. So lastly, the another important thing to keep in mind during a recession is if you have money that's in bonds. So bonds do play an important role in your overall investment strategy, even though the performance of bonds over the past few years has been very dismal. Also, with inflation increasing, inflation for most of the bond investments is higher than what those bonds are paying you in interest and a coupon rate. However, in period where stocks underperform, that's when bonds tend to outperform. So if you see your portfolio, your stock portion starting to decrease, a good place to look would be your bonds, and it could be a good time to rebalance things in your existing mix. Take as an example, if you're invested in a 70% stock portfolio, 30% bond portfolio, that 70% in stocks more than likely has dropped. It may be as low as 65%, and you may be as high as 35% that are in bonds. One way that you can rebalance your portfolio is to take that additional 5% that is now in bonds, and you can move that over into your stock bucket. And essentially, you would be buying into that stock bucket at a lower price point, which could be very advantageous for you moving forward. So if you have questions about your investments account, feel free to reach out or go to my website, www.incline-wealth.com. I'd be happy to connect with you there.